Welcome back to Trade with Conviction, your shortcut to making sense of the oil market when headlines are loud, price action looks calm, and the real signals are sitting underneath the surface. So first of all, Happy New Year to all of our listeners. This is our first pod of 2026. We hope you've had a good break and are gently reacquainting yourselves with your inbox, your screens, and the feeling that nothing ever really stops in this market. So today, flat price might look remarkably unbothered, but scratch a little deeper and there's a lot going on. So from Venezuela and heavy sour dislocations to Saudi OSPs, tumbling freight, and what's really driving the benchmarks right now. So we're going to separate the noise from the fundamentals and ask where the fundamentals are still setting the price at all. So look, with me today is Sparta's dream team of Neil, June and Phil. So welcome back all and let's get into it. Before we get into the physicals, let's deal with the headlines as usual. So lots being said and not all of it moving price. Right, Neil?
Right. Some prices are moving. And of course, we have to talk about Venezuela. Wasn't really on my bingo card for 2026 that Maduro would get kidnapped, essentially. So I just wanted to, just from an analyst, the poor old analyst point of view, it feels very like, just talking about the oil market, it feels very jading already because we start the year with complete unpredictability. And it's kind of fun from an analyst's point of view, not what's going on in the world, but it's fun from an analyst's point of view, but you can predict nothing. And I just have the feeling 2026 is going to go on like that, just as it did last year. So happy days, fun and not fun at the same time.
Tough one to call.
Yes, did not see that one coming. And of course, I think we all agree that flat price kind of did the right thing, partly because there's not going to be missing barrels, really. The barrels look likely to be redistributed across the globe. And of course, we can talk about what US plans are for Venezuelan barrels. But there's not going to be a lot of missing volume, and we're already seemingly long. Not that the front Brent spread would tell us that, but generally speaking, flat price is low, Dubai's in contango. So the market's kind of not so bothered by this news just now. Of course, assuming everything remains stable and there's no military backlash and so on and so forth. Fair statement?
I think that's fair for now. Yeah, it's beggars belief what will happen kind of in the next couple of weeks leading into IE week, mind. So
Yeah, and then we can get into the sort of nitty-gritty, what happens here. And of course, yesterday there was a few statements, one of them being that up to 50 million barrels so far will, what is it, have they been guaranteed or have they been commandeered? I can't even remember the phrasing.
Yeah, they've been
turned over.
I think it was turned over, exactly.
Okay,
they will be turned
willingly.
over. They promised to turn over up to 50 million barrels.
Okay, at this point, and that will presumably be marketed either within the US or potentially out with the US as well. Don't really know that yet. And the timeline also uncertain over what period. If it's over 12 months, it's not a big deal. And it's actually pretty much what the US takes already in terms of volume from Chevron. If it's over shorter time frames and more volume gets commandeered, let's say, or turned over willingly, then it becomes more interesting. You can see that the heavy sour diffs and the Canadian diffs responded quite strongly yesterday. So they fell off a cliff. That, I guess, is to be expected to a certain degree. We saw there was a reaction in Eastern fuel oil, which June can talk about later. Yeah. What else do you want to say? I think it's, on the whole, it's also kind of trending towards bearish for the legitimate crude market as things stand, because we see that US will possibly take more sanctioned barrels. They're still sanctioned at the moment. They may be unsanctioned, depending on what Trump's plans are. And the sort of end of the supply chain has been China, and the question is, what will China do? And that's what we're trying to figure out internally today, yesterday. Do they take just more Russian crude? Do they take HSSR? Can they make enough bitumen from these things? Do they take more TMX crude? Is there enough TMX capacity? Do you take TMX crude from West Coast and put that to China? What do the West Coast guys do? But it seems like they won't necessarily backfill all this volume with legitimate crude in China. Likely. It's likely that's the case. So it seems overall probably a bearish, oddly enough, a bearish development for the legit crude market, unless something blows up, of course.
Fair enough. I'm very glad we've got June on the call to talk a little bit more around the crude side. So
I think maybe just an extra comment on that. So the biggest loser, we have to again see who are the players in China that has been taking this Venezuelan oil. It's been the independent refineries or the teapots, definitely not the state-owned refineries. So whether the government will really step in to support them to find alternatives, at this point in time, I don't believe so. It's more probably the impact of the investments that, like CNPC has in Venezuela itself, that probably the government will need to come and intervene. But for our markets, the short-term oil flows, all this will still be within the sanctioned barrels regime where teapots will have still access to the Iranian barrels or the Russian barrels, be it crude or HSSR on these alternatives. And that's why we believe that it's not going to impact the legit market that much for now.
Thanks for that, June. And then I think we can also just put on the back burner the story about Venezuelan output rising, right? That's been doing the headlines and stuff. And I think most people agree the infrastructure is super decayed. And yeah, any kind of output hike is going to take a long time. I think that's a fair statement at the moment. So we can think about that more for the long term. If and when the situation stabilizes and US companies step in, XYZ needs to happen. So we can just ignore that just now, I think.
Yeah, I would indeed discount the supply increase, but maybe it's a displacement story that all of us should be looking at. If the Vance barrels goes to the US Gulf Coast, that kicks out the Canadian, and the Canadian comes to Asia. So that part I think will happen this year, but the incremental supply of sour crude might not be what the market envisions it to be.
Yeah, fair.
excellent. Well, look, Neil, anything else from your side before I kind of ask June to delve a little bit deeper into the crude market?
No, I had one extra bullet, but there's no point in even saying anything about it. It's like, what happens next? Obviously, Greenland's the next topic. Cuba's become a topic. Who the hell knows?
Iran.
But again, Iran's popping up again. So again, it just feels like any prediction that we make today, we're going to have to change it next week or next month. So it feels very disorientating.
Yeah, and that's fair. I think the geopolitics are always going to play kind of a massive part in our headline story anyway, so we can start to think about kind of what that looks like going into next week. Okay, June, whilst we have you onto crude, where Asia looks a little bit heavy, Dubai looks a little bit tired, and I think the Arbs are quietly reopening. So what have you got for us this week?
Okay, so I'll run off with the physical spot market. Saudi OSPs were released on the 5th of Jan. It was 30 cents down across the board for Asia. Fab Arab Light crude OSP was at 30 cents. It's very, very low. And however, the spot grades like Upper Zakum and Al Shaheen from the Dubai window has already weakened at the start of the trading window at discounts to Dubai. So it doesn't look like the medium-term barrels like the Arab Lights and the Arab Medium will be maxed out for this round of crude nominations. My expectation is that we should see allocation results significantly lower on the KBD basis for these medium crudes. However, Arab Extra Light still looks cheap versus Murban. Murban FOB diffs remain fairly steady at March Dubai plus about 130, I think, when I last saw it today. We are also heading into the March turnaround season, so we are expecting the Dubai benchmark to remain quite subdued. We're already seeing contango in the Dubai market compared to the rest of the crude benchmarks. Next week, we will see the Qatar Energy tender kicking off the spot market trading on the 13th of Jan. So there'll be more excitement over there once we come to the first of all, the nominations from the Saudi, allocation result from the Saudis, and then the Qatar Energy tender. What happened early while we were all celebrating the New Year, the China also had the second batch of crude import quotas announced. We were all predicting that, once it comes out, then, there's a lot more crude available for all the refineries to start buying again. But they only released 70% of the total quota. This has not been the case since 2023. They have been releasing the whole 100% number in the prior years. Checked around, there will be a third batch released later, but the number will not be announced so quickly. This signals two things. One, the government is likely to wanting to exert a bigger control on the independent refineries crude buying, depending on how the market conditions evolve this year. And secondly, they want to limit the ability to front load the crude quota. So all the the potential exuberance that the crude import quotas are going to be released, and therefore all these buys are coming back to the market, is now likely to be tapered off. And that's why we are seeing also the Dubai benchmark getting very heavy. Notably as well, we have a new refinery coming online this year in China, the Hubco 300 KBD setup. That has not been granted quotas in this round of allocation. So maybe it will be coming up a bit later in the second half of the year. We shall see about that.
Fair enough. Okay, that one's one to watch. It's quite a sizable refinery complex as well. So do we have anything new on the ARB signals for this week as well?
We saw freight rates, VLCC rates really free falling in a way from after Christmas onwards. And that's been a big factor into ARB's reopening somewhat into the Far East. WTI now is looking fairly attractive against Melbourne, comparable to attractive. WAF still has some ways to correct, but the CPC ARB is also closed. But it's a better story than maybe the last 1.5 months. On the flip side, we have the Brent Dubai EFS widening. The March Brent Dubai now is about 60 cents per barrel higher than last week, which is now about 130 or so. This is an indication of the market reacting to a light-heavy differential widening and the pressurizing impact on the Dubai side. That will then kind of shut off some of the ARBs as well. So it will be interesting to see how the rest of the FOB Premier will react to this on the ARB crudes.
Yep. All right. We'll pick that one up next week again then in that case. Thank you, June. I'm going to give you a moment's pause because I'd like to bring you back in kind of for the quick fire round. But look, let's move on to the light dens. So building on where we left things at the end of last year, if memory serves right, structures still doing the heavy lifting. We've got contango, storage, arbitrage opportunities, but we're starting to see a little bit more movement underneath. So Phil, why don't you walk us through what's changed since last year and where the pressure points are now, if that's okay?
Sure. So, yeah, if we think back just a few weeks, there was really no outlet for prompt European supply in particular. And that over the last few weeks has completely turned around. And it's we're now looking like we've actually got a pretty solid floor under EBOB and room to move higher again, actually. So contango has been spreading. It reached down to kind of Feb March, reached down to about $5 a ton earlier this week. That has already started to come up again, though. So there is storage opportunities both for EBOB or for components. So especially the higher octane components, with where Q2 gas nap is still trading. They look like it's you can definitely make a storage play work there. The Atlantic Basin ARBs have slightly opened up again for ARA origin. Places like Argentina, Colombia, for example. Importantly, the WAF ARB would be open on paper right now, but there are no import licenses around. So that's kind of an important distinction. So that's not hasn't been a supportive factor just yet, but may become one again, let's say towards the end of or the second half of this month as Dangote supplies or inventories start to dwindle. The way that at least the beginning of the year paired out for East-West was also opening up opportunities for European exporters into Australia, for example, into East Africa, South Africa, and the E10 blend margins opened up again. So it went from kind of having no outlet for prompt supply to having all of the outlets. And that has happened thanks to spreads, which came off. But if we look at kind of where the cracks are, the February EBOB crack is currently still at an all-time seasonal high. And on a dollar per ton basis, EBOB and ice gas oil are basically back to parity in February, which obviously seasonally is quite unusual to have winter gasoline and diesel back at dollar per ton parity. So what has that meant for the rest of the world? The pressure that we've felt on EBOB has been now transferred into the east. So Signature 2 is also sold off. The backwardation there is almost eroded into nothing. And essentially what we've had in the east is we've had some supply returning. So the second half of December saw a number of RFCCs returning. And we had the announcement of the Chinese export quotas, which were flat versus last year. So not really bullish, but at least not overly bearish either. And so essentially we've just had the market in the East needing to respond to kind of defend some of those ARB outlets that we're talking about in terms of Australia or parts of the Middle East or Africa.
Where are we on the US, though?
Finishing off the whirlwind tour. The main development there is that we've finally seen some life in the US Gulf Coast cash diffs. So that was a story for a lot of Q4, that it just looked as though the Gulf Coast was the supplier, or should be the supplier of choice to at least the Atlantic Basin and much of the Pacific as well. And that was not really having an impact on the cash diffs. We've started to see that come in a little bit now. So alkylate diffs have moved a bit higher so far this year. Refama, MTBE moving a bit higher, but they all still remain lower than they have been for the last few years. So it's helped a little bit, this uptick in the blend costs to equalize out that Atlantic Basin ARB outlook between Europe and the US, but it is still mostly pointing to the Gulf Coast for resupply. And that's kind of the PAD 3 story. And then for PAD 1, inventories built actually quite nicely through December. So we were talking kind of about how PAD 1 was very, very tight. They built quite nicely through December, essentially in line with seasonal kind of expectations. And that was on despite a very low TA ARB. So we had very, very closed kind of RBOB ARBs, but ARBs for components were open, for naphtha was open, and there was a very workable ARB kind of going via Borco. So it seems to have been a redistribution that way. Given all that, though, we still start 2016. We still start 2026 1 million barrels lower than the previous lowest seasonal level to start the year, which was 2023. So PAD 1 is still tight. It's just maybe not as extreme as it was, let's say, in early December.
Okay, so PAD 1 tight, full of blending components by the sounds of it. So they've got some work to do there. Okay, on the naphtha, any kind of news coming out of that for this week, out of that market?
It looks a bit more, well, I said a bit more supportive than gasoline, but actually EBOB started to turn around and looks quite supportive as well now. But the ARBs look pretty workable out of Europe. So both from Northwest Europe or the Med into New York, and from the Med into the East. So the Med ARBs East are improving again because the East-West just keeps on going from one new record high to another. And all in all, it's all looking pretty supportive, especially if we focus on, let's say, NWE naphtha. Feb-March is still in backwardation. And we've got this, Q1 gas nap has moved below $100 a ton as a result of EBOB selling off a little bit and just this underlying strength that we still seem to have in naphtha. So yeah, for now, it looks, I think that the next thing to move up again would be the cash diffs. So Med and Northwest Europe, but mostly the Med naphtha cash diffs took a bit of a hit through December, but now they look like they're in a place where they can start to charge a bit more again.
Brilliant. Okay. Just a reminder, I will kind of do a bit of a roundup at the end of this, because get your thinking hats on. It'll be kind of what are you watching going into next week. So, okay. I think we can probably now move on to the quickfire time. So why don't we pick out for this week fuel oil and maybe US diesel, and let's do this in rapid response mode. So what's changed, what's priced, and what's probably not priced in. So June, do you want to take us away kind of on fuel oil?
Yep, sure. So this is with discussion with Hua. We've seen cracks for high sulfur fuel oil got up quite a bit in Singapore, and the contango has been gone as well. However, if you are just looking at the mass balance, this Venezuelan barrels that goes into US Gulf Coast is bearish for fuel oil into that region because it will displace Mexican HSSR into the US, and the cokers will have, we are assuming already the cokers are at the max utilization right now. So for Chinese seaports, they will then look to fill up on Russian HSSR. Looks like there's plenty of water available still, and therefore likely very little legitimate high sulfur impact until we start the pre-summer stock building. The move up that we saw yesterday, which is the 7th of Jan on the 180 east-west, looks overdone. Okay. At this 2 days when we look at the window, it started to fall off as well. So I think the market reacted prematurely to the fuel oil news.
Okay. All right. We'll look out for kind of one of Hua's snippets or commentaries as well off the back of that. Neil, do you want to take us away on the US distillate side?
Yeah, very quick roundup. I guess the main mover that we see recently is the HOGO. And so that is really coming from the heating oil complex. So the ICE gas oil spreads have been pretty range bound for quite a while by now. What's happening in the US is that you have relatively warm weather, you have decent stock builds, you have high runs. Stocks are still quite low in pads 1 and 2, but generally getting decent builds. And what this has been doing is pricing the US Gulf MR ARBs into Europe quite a lot over the last few weeks. It's now closed, but of course flows depend on, let's say the average levels or the number of opportunities you get to fix cargoes over to Europe, and that looks to have been ample. And the other thing on the back of that is that the usual sort of swing barrels, West Coast India barrels, those are now parity between East and West. So it looks like, just from the ARB picture, there might be plenty of resupply into Europe over the next 1 to 2 weeks, months. And maybe that's what's keeping Europe actually depressed a little bit. And of course, I think many of us in Europe can feel that it's extremely cold. And that's typically would be a kind of bullish thing for ice gas oil, but it's not making any difference at all as far as I can see. So maybe that's just that's what's happening on ice gas oil for the next couple of weeks.
Fair enough. I agree with the cold sentiment of Europe. My house is absolutely Baltic. Okay, so why don't we kind of do a quick roundup? June, what's the one thing that you're looking at going into next week, or you're keeping an eye on?
I'm going to continue watching the Brent Dubai EFS. It has done quite a big of step up already this week. Not sure whether the strength can be sustained or even widened further. So my opinion is likely to stay at around these levels, the one maybe up to 150 or so. And then we will see how the rest of the FOB corrects for the AG crudes next week.
Brilliant. Okay, Phil, on light ends, what have you got for us?
Yeah, so as I mentioned, that kind of EBOB looks like it's hit a floor now. It's got plenty of supportive factors. I think as soon as we start to see any indication of a return for the WAF ARB, i.e. any kind of buying or import licenses, for there, I think we can actually start to see EBOB rallying again, even though we are still in the depths of winter.
Okay. Brilliant. I will test you on that next week. And Neil, appreciate you've got a bag of uncertainty with kind of everything that you talked about today, but is there anything in particular that you're looking at going into next week?
Yeah, I'll sort of piggyback on top of what June said. So one thing we didn't really discuss is the state of the North Sea, and it's still a bit of a perpetual conundrum why Brent stays in backwardation, 40, 50 cents. Of course, there's geopolitical risk. Just looking at the ARB perspective, though, nothing's arbing east. TI looked expensive, but now TI Brent is completely gapped wider, and it's kind of normalized again. So TI looks cheap in Northwest Europe, and I just feel like I don't understand why North Sea can stay so expensive. It was the same case last month as well. At some stage, it's going to come off, and the weight of supply, which seems to be high, needs to make a difference.
Okay. All right. We'll check in on that next week. I think that's kind of where we land for this week's pod in that case. So flat price is doing its best impression of calm and collected, but underneath there are a few fairly loud cracking noise. So heavy sour crude under pressure, benchmarks looking a little bit tired, freight reopening ARBs, and geopolitics elbowing fundamentals out of the way to a certain extent. So look, the near-term risks still lean to the downside by the sounds of it from you guys. And for a lot of the barrel, it's less about how much supply exists and more about where it can actually really go and how expensive that journey is. By the way, we have a platform for that. So look, as always, conviction doesn't come from chasing headlines. It comes from understanding the physical reality beneath them. So to all of our listeners, thank you for this week, for tuning in to Trade with Conviction. We're going to be back next week with another read on the market. So until then, stay sharp, stay curious, and good luck out there.